Imagine you're looking at a corporate earnings report, right?
Mm-hmm.
And you see that a company actively chose to spend, literally millions more on advertising.
Right, which happens.
It happens, yeah. But simultaneously, they're generating a significantly lower return on every single dollar they just spent.
Ouch. Yeah, that's usually a red flag.
Exactly. If you run that through a standard financial analysis filter, it looks like a complete disaster.
Oh, absolutely.
You would just naturally assume, well, the marketing team is burning cash, or maybe the core product is just completely failing to resonate with consumers.
You'd think they were just throwing money into a void.
Right. But today, we are looking at a company that did exactly that, and yet, well, the deeper you dig into the data, you realize it is actually a massive strategic victory.
It's wild. It completely defies the standard Wall Street playbook.
It really does.
Because, we are so heavily conditioned to look for a constantly rising return on ad spend. That's like the holy grail of efficiency.
Right, the magical ROAS metric.
Yeah. Exactly. So a deliberate suppression of that metric. It just feels totally counterintuitive.
Completely.
But looking closely at the mechanics of global travel, you realize that sometimes you actually have to intentionally lower your immediate return to capture a dominant market position.
Well, welcome to this Talk Ticker style deep dive. Our mission today is to take a massive stack of sources, specifically the Q4 2025 earnings call data and management commentary for Trivago NV.
Ticker symbol TRVG.
Right, TRVG. And we're going to extract the actual actionable insights for you.
Strip away all that corporate fluff.
Exactly. Whether you currently hold this stock or maybe you're eyeing it as a potential turnaround play in the $1.6 trillion global travel market, we are stripping away the jargon to give you the exact financial reality you need.
No sugarcoating.
None. We're going to look at the headline numbers, unpack the underlying strategic shifts driving those numbers, translate management's guidance for 2026, and ultimately deliver a heavily opinionated verdict on where this company actually stands.
I love earnings calls because, management teams are constantly trying to walk this tightrope.
Oh, yeah. The balancing act.
Right. They have to highlight their victories while sort of contextualizing their shortfalls.
Usually by burying them in accounting terminology.
Exactly. Burying the crucial operational shifts under layers of jargon. So our goal here is to deconstruct that data so you can see the actual machinery of the business.
So let's dive straight into the headline numbers. And honestly, the data coming out of the fourth quarter of 2025 is incredibly robust.
It really is.
We are looking at total revenue for Q4 hitting 120 million euros.
Which is huge.
Right. That represents a 27% year-over-year increase.
Wow.
And more importantly, for anyone tracking momentum, this marks Trivago's 5th consecutive quarter of total revenue growth.
5 quarters in a row.
Yeah. We are no longer looking at a momentary spike, we're looking at a solidified trend.
The word momentum is critical there, because when a mid-cap tech company claims they're executing a turnaround, the market is usually highly skeptical.
Oh, Wall Street doesn't believe you until you prove it.
Right. Investors look for false positives. You often see a company slash prices or run some unsustainable promo campaign just to juice the top line revenue for a single quarter.
Just to make the slide deck look good.
Exactly. Only to watch it completely collapse 3 months later. So stringing together 5 consecutive quarters of growth.
And accelerating that growth to 27% in the final quarter.
Right. That demonstrates that the underlying demand for the platform is structurally sound.
But, top line revenue only tells half the story.
Always.
If a company is spending $2 to make $1, a 27% growth rate is literally just a faster path to bankruptcy.
A very fast path.
So we need to look at the profitability metrics to see what they're actually taking home. In Q4, Trivago reported a net income of 14.5 million euros.
Solid.
And alongside that, their adjusted EBITDA came in at 11.3 million euros, a figure that management actually noted was ahead of their own internal expectations.
We should probably take a second to unpack why adjusted EBITDA is often the preferred lens for evaluating a company in this specific sector.
Yeah, why not just stop at net income?
Well, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
And in the tech and platform space, a company might have massive depreciation on past acquisitions or, complex international tax structures.
But you got to muddy the waters.
Exactly.
Right.
It obscures how much actual cash the core business is generating month to month. Adjusted EBITDA strips out all that accounting noise.
I see.
So seeing 11.3 million euros there tells you the daily operations of the search engine and booking platform are highly cash generative.
Okay, so to give you, the listener, the full context, we really have to look at the entire 12 months of 2025.
Zoom out a bit.
Yeah. For the full year, Trivago delivered 19% total revenue growth and generated 15.8 million euros in adjusted EBITDA.
That's a great full year picture.
When CEO Johannes Thomas and his leadership team stepped back into the company in mid-2023, they actually established a multi-year theme.
What was it?
They called 2025 the year of turning the tide.
Catchy.
Right. But looking at a 19% expansion in top-line revenue while remaining EBITDA positive, I mean, the data suggests they executed that mandate almost flawlessly.
They absolutely arrested the decline that had plagued the platform in prior years. But, the metric that truly separates Trivago from a lot of its peers in the mid-cap tech space, it's found on the balance sheet.
Okay, lay it on me.
They ended the year with 130.9 million euros in cash and cash equivalents and zero long-term debt.
Wait, zero?
Zero long-term debt.
Let that sink in for a second, because the macroeconomic environment we're currently operating in makes that statistic incredibly rare.
It's basically a unicorn metric right now.
Right. Over the last few years, we've seen interest rates rise dramatically. Companies that relied on cheap debt to fund their operations or mask their operational inefficiencies.
They are suffocating right now.
Suffocating under the weight of their own interest payments.
Yeah.
Refinancing debt in 2025 is punitively expensive.
Absolutely brutal.
And here's Trivago, sitting on over 130 million euros in cash without a single long-term debt obligation dragging down their free cash flow.
And that pristine balance sheet functions as a massive strategic moat.
How so?
Well, the travel industry is notoriously sensitive to macro shocks. Think about currency fluctuations, inflation spikes, geopolitical instability.
Or just shifts in consumer confidence.
Exactly. When a highly leveraged travel company faces a sudden downturn in bookings, their immediate priority is just survival.
They go into panic mode.
Right. They have to cut marketing, halt product development, lay off engineers, all just to make their debt payments.
Just to keep the lights on.
But Trivago's cash position allows them to play offense during those exact moments.
Oh, that makes sense.
They can acquire distressed assets, hire top talent, or capture market share while their competitors are forced into this defensive posturing.
I want to test the strength of these numbers, though.
Okay, let's do it.
Because it's easy to look at a 27% Q4 revenue jump and just declare victory. But during the earnings call, management specifically cited foreign exchange headwinds.
Right, the currency stuff.
Yeah, they noted that currency fluctuations shaved off about 5% of their growth globally. So if we're dealing with all this currency noise, are these top-line numbers actually an accurate reflection of platform adoption?
Or are they inflated?
Exactly. Is it possible that global inflation and weird currency translations are artificially inflating the results?
Well, the currency dynamic actually makes their performance significantly more impressive.
Wait, really? How?
We have to look at the mechanics of foreign exchange translation. Trivago is a European company, right? So they report their earnings in euros.
Okay, tracking.
However, they generate a massive portion of their revenue in US dollars, Brazilian reals, Japanese yen, British pounds.
Right, they're global.
So if the euro strengthens against those local currencies, the revenue Trivago earns abroad translates into fewer euros on their final earnings report.
Oh, so you're saying the 5% headwind means their reported revenue is actually artificially depressed, not inflated.
Precisely the opposite of artificial inflation.
Wow.
If currency exchange rates had remained perfectly flat year over year, their Q4 growth rate would have been 5% higher than the 27% they reported.
So it would have hit 32% growth.
Exactly. And to prove this wasn't just an illusion, we can look at their regional referral revenue data. They saw double-digit growth across every major geographical segment.
Let's hear the breakdown.
The Americas were up 20%.
Nice.
The rest of the world segment grew by 16%, and developed Europe grew by 15%.
So it's literally everywhere.
Yeah, this is fundamental, broad-based utilization of their platform across multiple continents, completely cutting through the negative currency drag.
That broad-based growth naturally leads us to ask how they achieved it, because a balance sheet full of cash is only useful if you actually deploy it effectively.
Right, cash doesn't do anything just sitting there.
So let's transition into the story driving these numbers. Based on the source material, the most significant driver of this turnaround was a massive, calculated pivot in their marketing strategy.
A total paradigm shift for them.
Yeah. For over a decade, meta search engines like Trivago relied really heavily on performance marketing. We're talking about search engine marketing.
Okay.
Basically buying keywords on Google.
The traditional model was highly transactional. A user types cheap hotel in Rome into a search engine.
Right.
Trivago, Booking.com, and Expedia all enter this real-time automated bidding war to have their link appear at the very top of those search results.
And whoever pays the most gets the click.
Exactly. But the fundamental flaw in that strategy is that you're essentially renting your customer from the search engine.
Oh, that's a great way to put it. Renting the customer.
The moment you start paying that toll, your traffic evaporates entirely.
It's a treadmill you can never step off of.
No.
And what Trivago decided to do was, step off the treadmill.
Yeah.
They shifted a significant portion of their capital away from that performance marketing dependency and redirected it into sticky brand building campaigns.
Going for the long game.
Exactly. They want to bypass the search engine intermediary altogether. The goal is to build enough mental availability that when you decide to take a trip, you don't Google hotels in Rome.
You just go straight to the source.
You simply type Trivago into your browser, or you open their app directly.
And to achieve that, they expanded aggressively into upper funnel media.
Right, like what?
They bought inventory on streaming services, sponsored major podcasts, and launched a massive AI-powered summer campaign featuring the global sports icon Jurgen Klopp.
Oh yeah, that campaign was everywhere.
It ran across 30 different countries. Brand marketing is designed to build a durable relationship rather than secure just a one-off transaction.
And does the data back that up?
It does. The data from the call validates this pivot. Management specifically noted that the growth of their branded direct traffic revenue has significantly outpaced their overall top-line revenue growth.
So people are actively seeking out the brand.
Exactly.
But this brings us back to that metric I mentioned in our introduction, the anomaly that might terrify a casual investor.
The ROAS drop.
Yes. While discussing this massive brand marketing push, the earnings report showed a significant decrease in return on ad spend, ROAS.
Which looks scary on paper.
Globally, ROAS dropped in Q4 from 162.9% a year prior down to 147.9%.
That's a noticeable dip.
And in the Americas, the drop was even more severe, falling to 137.5%.
So if you build a simple financial model, seeing marketing spend go up while the return on that spend goes down, that triggers immediate alarm bells.
Right. It looks like diminishing returns. It looks like the Jurgen Klopp campaign cost a fortune and just completely failed to generate proportional bookings.
Exactly.
My immediate thought is that they overpaid for podcast ads and television spots, and the consumer just didn't bite. So how do you analyze that ROAS drop and conclude it's actually a strategic victory?
Well, we have to look at the seasonal mechanics of global travel and media buying.
Okay.
This drop in ROAS was not a failure of the brand campaign. It was a highly calculated allocation of capital.
Elaborate on that.
In the fourth quarter, Trivago deliberately leaned into the Latin American markets. The peak summer travel season in the Southern Hemisphere is the exact inverse of the United States and Europe.
Right, of course.
While the Northern Hemisphere is settling into winter in December, Latin America is entering its absolute peak travel demand window.
So they recognized the geographical misalignment and just exploited it.
Furthermore, they were deeply opportunistic regarding media pricing.
What do you mean?
During the call, management explained that they have teams constantly analyzing media inventory worldwide. They identified highly attractive pricing for ad exposure in key Latin American markets during Q4.
Like discounted TV spots and things like that.
Exactly. And they bought it aggressively. They knew this heavy, concentrated spend would temporarily suppress their global return on ad spend percentage in the short term.
Because brand marketing takes time to convert into actual bookings.
Precisely. You run the ad in December, the consumer remembers the brand, and they book their trip in January or February.
I see.
Trivago accepted a lower ROAS in Q4 because they expect a highly lucrative long-tail return on that investment in the subsequent quarters.
Okay, that reframes the metric entirely. A declining ROAS in this specific context is not a symptom of inefficiency.
Not at all.
It's evidence of an agile, opportunistic marketing team that's willing to take a short-term optical hit for long-term market share.
And it requires a management team that is not terrified of Wall Street's immediate reactions. They are managing the business for fundamental growth, not just to make the current quarter's spreadsheet look perfect.
Which is refreshing, but marketing only gets the user to the front door.
True.
All the brilliant brand positioning in the world is completely useless if the website is a nightmare to navigate.
We've all been there.
This leads us to the product and technology upgrades, and honestly, the growth metrics here are staggering. I'm going to outline 3 specific data points from the call.
Let's hear them.
First, overall conversion rates are up 37% compared to 2023.
Massive.
Second, a specific feature called Trivago Book Go surged 137% compared to Q4 2023.
Also massive.
And third, they rolled out a new transaction-based CPA cost per action model for their hotel partners, which is now driving over 25% of their referral revenue.
We really need to connect the underlying mechanisms of those 3 metrics, starting with the 37% increase in conversion.
Yeah, let's unpack that, because 37% sounds huge.
In the e-commerce sector, a team will throw a party if they can bump their conversion rate by 0.5%.
Right.
Increasing conversion by 37% over a 2-year period means the fundamental architecture of the platform has been radically overhauled to remove consumer friction.
Let's isolate exactly where that friction used to live, because anyone who has used a travel comparison site knows the pain points.
Oh, intimate.
Historically, Trivago functioned strictly as an aggregator. You search for a room in Paris, they showed you a list of prices from 50 different websites.
Right.
You found the best deal, you clicked the link, and suddenly you were redirected away from Trivago. You might land on Expedia, or you might land on a clunky, poorly designed website for a small boutique hotel that you have never heard of.
And that redirect is the ultimate conversion killer.
It's jarring.
Very. The user experiences this jarring change in user interface. The new website might take 5 seconds to load. The currency might suddenly display differently.
And the user immediately loses trust, they abandon the session, and the booking is lost.
Exactly. The Trivago Book Go feature, which you mentioned, grew by 137%.
Yeah.
That is the direct solution to that exact problem.
So if I understand the mechanics properly, Book Go allows the user to complete the entire transaction without ever leaving the Trivago interface.
Exactly. The branding stays consistent, the user experience is seamless, and the friction of the redirect is entirely eliminated.
That makes total sense.
The massive growth of that specific funnel proves that modern consumers demand a unified, frictionless ecosystem. By keeping the user on their own interface, Trivago builds trust and ensures the transaction actually clears.
Right.
But the consumer experience is only one side of a marketplace. We also have to look at how Trivago altered the mechanics for their suppliers, the hotels themselves.
Ah, the CPA model.
Yes. This brings us to the CPA, or cost per action model.
So why does a shift in how hotels pay Trivago matter to someone analyzing the stock?
Because it fundamentally alters the risk profile for the supply side of the marketplace, and that leads to a healthier, more diverse platform.
How did it work previously?
Previously, hotels had to use a cost per click, or CPC, model.
Okay.
If a user clicked on a hotel's link on Trivago, the hotel paid a fee, regardless of whether that user actually booked a room.
Just for the click.
Just for the click. Now, for massy conglomerates like Marriott or Booking.com, that is fine. They have enormous data science teams optimizing their bids to ensure profitability.
They can absorb the cost.
Right. But for a small independent hotel in Florence, paying €2 for every click without a guaranteed booking is incredibly risky.
Right, they could drain their entire marketing budget on clicks and secure 0 actual guests.
Exactly.
So the CPA model shifts the financial risk entirely away from the independent hotel and onto Trivago. The hotel only pays a commission if, and only if, the booking is finalized.
Yep. And the fact that over 140 partners have already adopted this model, driving a quarter of Trivago's referral revenue.
That's a big chunk.
It indicates that smaller suppliers are aggressively re-engaging with the platform. It levels the playing field, allowing unique independent hotels to compete alongside the massive booking conglomerates.
Which is great for the user.
Exactly. A marketplace with diverse, high-quality supply is inherently more attractive to the consumer.
Better marketing, frictionless booking, and a supplier-friendly economic model. But there is one more vital component to the operational story here, and it centers on the most ubiquitous concept in modern technology: artificial intelligence.
Ah, yes. AI.
CEO Johannes Thomas made a statement during the earnings call that is really worth dissecting. He outlined a vision where Trivago will use AI to, quote, operate with 600 people as if we were 6,000.
That is an astonishing claim of operational leverage.
It's massive.
To understand the gravity of that, consider the traditional economics of a tech platform. Historically, the single largest fixed cost is human capital.
people.
Right. If you wanted to scale your revenue by a factor of 10, you generally had to scale your engineering, marketing, and customer service headcounts by a similar magnitude.
You needed more people writing code, more people localizing ad copy for different languages, more people analyzing data.
And scaling that headcount historically devours your profit margins.
I have to challenge this, though.
Go for it.
Because it feels like every single tech CEO in 2025 is legally obligated to throw around massive AI productivity claims just to keep their stock price up.
Oh, the hype cycle is very real.
Right. So is this just corporate buzzword bingo, or is there a functional, observable mechanism here?
The evidence actually points to functional integration, not just surface-level hype. We can see it in both their consumer-facing product and their internal operations.
Okay, give me some examples.
On the consumer side, they launched a natural language AI smart search late in 2024.
How does that work?
Instead of clicking 20 different filter boxes for, swimming pool, pet-friendly, and under 200 euros, a user simply types a conversational sentence describing their ideal trip.
Oh, that's much easier.
Behind the scenes, large language models are parsing thousands of hotel reviews and summarizing them into a single, highly accurate paragraph.
Saving the user from reading endless pages of conflicting opinions.
Exactly.
Okay, that done with the consumer experience. But what about the internal operational leverage? How does AI replace 5,400 hypothetical employees?
Think about the manual labor involved in running a global marketing operation.
Right.
Previously, adjusting bidding strategies across dozens of countries, localizing ad copy into different languages, and running A/B tests that required an army of media buyers and analysts.
Spreadsheets everywhere.
Exactly. Trivago is now utilizing advanced machine learning algorithms to automate those real-time bidding adjustments and localize content instantly.
Wow.
Their engineers are using AI coding assistants to deploy software updates significantly faster. They are running hundreds of complex product experiments every quarter without expanding their payroll.
So they're just moving faster with the exact same team.
Yes. And if they can truly decouple revenue growth from headcount growth, the long-term margin expansion will be exponential.
That structural shift in how the business operates provides a perfect bridge into the third major area of our deep dive management guidance.
Looking ahead to the future.
Right. Everything we've discussed so far is historical. The market, however, prices a stock based on its future cash flows. Management introduced a new operational theme for 2026, calling it Optimizing Momentum, Pushing Frontiers.
Very poetic.
But buried beneath the corporate branding was a major shift in their financial reporting structure that we really need to unpack. Moving forward, Trivago is discontinuing guidance on referral revenue and will exclusively report on total revenue.
And when a publicly traded company announces they are abandoning a metric they've relied on for over a decade, the analytical community immediately goes on high alert.
Oh yeah, red flags go up everywhere.
Financial models are built on historical continuity. When management suddenly removes a familiar variable, the instinctive assumption is that the specific metric is deteriorating and the company is just trying to hide the damage.
Exactly. If a company stops telling me how many widgets they sold and only tells me their overall revenue, I just naturally assume widget sales are falling off a cliff.
That's the logical conclusion.
So we need to translate the accounting reality here. Why are they making this change? And is it a legitimate structural necessity or is it a smokescreen?
I can tell you, it is a structural necessity driven entirely by the evolution of their business model. To understand why, we have to look at their acquisition of a company called Holisto, which has since been integrated and rebranded as Trivago Deals.
Right.
And this circles back directly to our earlier discussion about the Book Go feature.
Let's map the mechanics of that.
Yeah.
Under the old model, referral revenue was perfectly accurate. Trivago generated a lead, referred the user to Expedia, and collected a fee. They were essentially a sophisticated traffic director.
Exactly. But with Book Go and Trivago Deals, they are operating much closer to the merchant of record.
The merchant of record. Okay, that's a key term.
Yes. When a user completes a transaction through Trivago Deals, Trivago is the entity processing the payment.
They take the credit card.
Exactly. Because they are facilitating the transaction directly within their own ecosystem rather than referring the user outward, complex intercompany accounting rules are triggered.
Ah, I see where this is going.
If you strictly isolate the old definition of referral revenue, the money generated internally through Trivago Deals gets eliminated in the intercompany accounting consolidations.
Oh, the mechanics of that are fascinating. So if an analyst is stubbornly looking only at the legacy referral revenue line item, They are completely blinding themselves to the massive triple-digit growth occurring inside the Book and Go and Trivago Deals segments.
They're missing the real story. And CFO Wolf Schmuhl addressed this explicitly during the Q&A portion of the earnings call.
What did he say?
He stated that continuing to focus on referral revenue would present a distorted and fundamentally incomplete picture of the company's financial velocity.
Right.
As the seamless on-platform booking experience becomes a larger percentage of their business, the legacy referral metric just loses its relevance. Shifting the focus entirely to total revenue is the only intellectually honest way to measure the top-line performance of the integrated platform moving into 2026.
Okay, with the accounting methodology clarified, let's look at the hard numbers they're promising Wall Street for the upcoming year. Management is projecting double-digit percentage total revenue growth for 2026.
Which is strong.
Crucially, they have set an adjusted EBITDA target of at least 20 million euros. Stepping up from 15.8 million this year to a floor of 20 million next year signals intense confidence in their ability to expand profit margins.
They also provided some granular color on the immediate future, noting that they expect to deliver their 5th consecutive quarter of double-digit growth in Q1 of 2026.
Which is particularly impressive considering they're comping against a very strong first half of 2025.
Exactly.
The natural question is how they mathematically achieve that 20 million euro EBITDA floor. Earlier, we detailed their massive pivot into expensive upper funnel brand marketing.
Jurgen Klopp ads and all that.
Right. Running campaigns across 30 countries is incredibly capital intensive. So how do they expand their profit margins while simultaneously funding global advertising?
The mechanism driving that profitability is a planned deceleration in the growth rate of their marketing spend. Management introduced a critical phrase during the call, a digressive curve.
A digressive curve. Let's translate that into practical terms for the listener. If a company increased their marketing budget by, say, 20% in the previous year, a digressive curve implies they might only increase it by 5% or 8% in the following year.
Think of it like achieving orbital velocity in a spacecraft.
I love a good space analogy.
You have to burn an absolutely massive amount of expensive rocket fuel just to break through gravity and establish your initial orbit.
Right.
That represents the heavy brand marketing investments Trivago made over the last 2 years to reestablish their mental availability globally.
Just burning cash to get up there.
Exactly. But once you are safely in orbit, you don't need to keep firing the main engines at full capacity. You only need small, periodic thruster bursts to maintain your momentum.
That is an illuminating way to look at it. The foundational costs of entering new markets and capturing mindshare have already been paid.
The heavy lifting is done.
Now, the strategic priority transitions from aggressive acquisition to optimization and harvesting.
In prior years, the highly profitable core regions essentially had to subsidize the expensive expansion efforts in emerging markets.
Right.
In 2026, because the brand awareness is already compounded, they can achieve their double-digit revenue growth targets without requiring a proportional explosion in marketing spend.
So revenue grows faster than expenses.
Exactly. That slower, digressive growth in the advertising budget is the exact mathematical lever that forces more cash to fall to the bottom line, virtually guaranteeing they clear that 20 million euro EBITDA threshold.
Okay, we have dissected the headline numbers, mapped the strategic pivots driving the turnaround, and analyzed the structural logic behind management's 2026 guidance.
We've covered a lot of ground.
We really have. It is time to synthesize all of this data into our final segment, the bottom line. This is where we distill the complexities into actionable insight.
Time to take a stand.
Exactly. Based on the totality of this earnings call, how should retail investor orient themselves toward this stock? I will ask you for a definitive stance, bullish, bearish, or neutral.
Well, analyzing the $1.6 trillion global travel market is always an exercise in balancing macro risk against micro execution.
Sure.
However, given the specific financial architecture Trivago has built, I am issuing a cautiously bullish signal for investors seeking a turnaround asset.
Okay, cautiously bullish. I will take the role of synthesizing the core tenets of that bull case for you, the listener. The argument really rests on 3 solid pillars. First, you have a company that has completely insulated itself from the most dangerous threat in the current economy debt.
The zero debt is huge.
With zero long-term debt and a 130.9 million euro cash fortress, bankruptcy, or punitive refinancing scenarios are entirely off the table. They just have the luxury of patience.
They can wait out the storms.
Exactly. Second, they have a highly credible, mathematically sound roadmap to generate at least 20 million euros in EBITDA next year, driven by that controllable, digressive marketing curve we just talked about.
Right. And the third pillar of the bull case, which actually might be the most vital for long-term survival, is user lock-in.
Let's talk about that.
During the call, management highlighted a metric that we haven't even touched on yet. Revenue generated specifically from logged-in members is up 93% since Q4 of 2023.
93%. Wow.
And it now constitutes more than 25% of their total referral revenue.
Okay, but why is a logged-in member exponentially more valuable to the platform than an anonymous user? I mean, a booking is a booking, right?
Not quite, because a logged-in member breaks the dependency on search engine marketing entirely.
Oh, right.
If a user has an account, the platform can offer them exclusive member rates, highly personalized search results based on their past behavior, and a completely frictionless book and go experience.
They just open the app and everything is there.
Exactly. More importantly, Trivago doesn't have to pay Google €2 for a click every time that user wants to book a vacation.
Because they didn't come through Google.
Right. By rapidly expanding that logged-in member base, Trivago is transforming from a transactional one-off utility into a trusted recurring destination. They are actively digging a moat to protect themselves from the larger tech monopolies.
A fortified balance sheet, expanding margins, and a rapidly growing, loyal user base. I mean, the bull case is highly compelling.
It's strong.
But your signal was cautiously bullish.
Yes, the cautiously is important.
To maintain strict analytical objectivity, we have to look at the other side of the ledger. What is the primary bear case? What data points in this call give you the most anxiety?
The most significant warning light flashing on the dashboard comes from their commentary regarding the Americas segment.
The U.S. market.
Yes. While the overall revenue in the region grew, management explicitly flagged a troubling macroeconomic trend. They are observing a double-digit decline in international inbound travel to the United States from key markets like Canada, Germany, and France.
Okay, a double-digit decline is severe. But let's look at the underlying economics of that. Why does a drop in international travel disproportionately threaten Trivago's bottom line, even if domestic U.S. travel remains steady?
Because international bookings are the most lucrative transactions in the travel sector. Consider the profile of a German tourist traveling to New York City versus a family from Ohio driving to Chicago for the weekend.
Totally different scale of spending.
Exactly. The international trip involves a much longer length of stay. It generally commands a significantly higher average daily rate, or ADR, because international travelers tend to book premium accommodations.
They're treating themselves.
Right. It also involves greater complexity, often bundling flights, extended hotel stays, car rentals.
So the sheer size of the transaction is vastly larger, meaning the percentage commission Trivago earns is substantially higher.
You nailed it.
Yeah.
And alongside that drop in highly profitable international inbound traffic, management noted that U.S. consumers are exhibiting a shift toward cheaper, shorter domestic trips.
Ping down.
Exactly. As a result, the clicked average booking value, which is the total monetary size of the trip a user is searching for in the Americas, was actually slightly negative going into the first quarter of 2026.
Wow. So the mechanics of the platform are working perfectly.
Yes.
Conversion is up 37%. More people are clicking and booking, but the actual financial value of the trips those users are taking is shrinking because of macroeconomic pressure.
That is the ultimate macro risk. If inflation remains sticky, or if economic uncertainty accelerates, consumers in Trivago's most crucial geographic market might continue to trade down.
Right. A user who traditionally booked a 4-star resort in Hawaii for 10 days might downgrade to a 3-star hotel in Florida for a long weekend.
Precisely. Even if Trivago's AI optimizations and brand marketing execute flawlessly, they cannot force a constrained consumer to purchase luxury vacations.
You can't squeeze blood from a stone.
Exactly. If the average booking value continues to slide, it will place heavy gravitational pressure on their overall revenue growth, regardless of how efficient the platform becomes.
That is a critical variable for any investor to monitor. You really need to keep a very close eye on U.S. consumer spending data and global transatlantic airline booking trends as, leading indicators for the health of Trivago's Americas segment. The internal machinery is repaired, but the weather outside remains highly unpredictable.
It requires vigilance, definitely, but the company is navigating those waters from a position of profound financial strength.
We have covered a massive amount of operational and financial ground today. Let's compress the core takeaways into a rapid summary. Total revenue surged 27% in Q4, finalizing 5 consecutive quarters of growth.
Momentum is established.
The strategic pivot away from rented search engine traffic toward owned brand loyalty is actively working, even as it temporarily suppresses ROAS. Fundamental product upgrades, specifically the frictionless Book and Go interface, are driving massive 37% conversion gains.
Huge product wins.
And supported by a fortress balance sheet with zero debt, management has outlined a clear, mathematically sound path to expanding profitability in 2026.
It really is a textbook example of a mid-cap turnaround that has moved past the stabilization phase and re-entered a phase of sustainable execution.
Before we conclude this deep dive, there's one final provocative concept from the source material that I think warrants deeper reflection. We discuss CEO Johannes Thomas's assertion that AI integration will allow their 600 employees to generate the operational output of 6,000.
I really want you to consider the broader tectonic implications of that statement for the entire technology sector.
It's big.
It is. For the better part of the last 15 years, the online travel space has been utterly dominated by a handful of legacy conglomerates.
Booking, Expedia.
Right. And these monopolies won primarily through brute force scale. They had tens of thousands of employees and bottomless marketing budgets that smaller companies simply could not compete against.
The prevailing logic was that scale was an insurmountable advantage. The giants could simply outspend and out-engineer everyone else.
But if Trivago's hyper-efficiency thesis proves accurate, if a lean, highly focused team of 600 people can genuinely punch at the weight of a conglomerate by leveraging large language models for rapid product development, automated marketing localization, and internal productivity, it changes the physics of the industry.
It really does.
We have to ask, could artificial intelligence be the great equalizer? Could this technology be the precise weapon that finally allows nimble, highly focused mid-cap companies to actively dismantle the moats of lumbering monopolies and reclaim significant market share?
It's a fascinating question that extends far beyond the travel industry. Honestly, it might be the defining narrative of tech investing for the next decade.
We will certainly be tracking the data to see if that thesis holds true in the coming quarters.
And we hope you will be tracking it right alongside us. Thank you for joining this Talk Ticker style deep dive. We hope this breakdown armed you with the precise data, the underlying mechanics, and the strategic context you need. Until next time, look beyond the corporate jargon, keep questioning the numbers, and happy investing.